Welcome to Market Call here on BNN Bloomberg. I'm Paul Bagnall. Our guest today is Andrew Moffs. He's Senior Vice President and Portfolio Manager at Vision Capital. He'll be talking real estate stocks and real estate investment trust, REITs. So real estate is our focus. Get your questions in. He'll be taking your questions for the next hour or so, approximately. We'll also have time to take a look at his past picks he gave us about a year ago, and we'll conclude the program with a fresh batch of top picks from Andrew Moffs. Here's our toll-free number. As always, it is 1-855-326-6266, and our email address is marketcall@bnnbloomberg.ca. So get your questions in. Lots of opportunity to get through to Andrew Moffs on your real estate questions. Andrew, thanks a great deal. The market is very focused on inflation these days, whether transitory or more persistent. You made the comment in some recent commentary that REITs, real estate investment trusts, have typically been viewed, and correctly, you think, as a hedge against inflation.
Yeah, that's correct. I mean, I'd say, first of all, at Vision, I think we're more in the camp where we think inflation is going to persist, and we're seeing it. And yes, we think it bodes well for real estate, both the private market and the public markets. With real estate, as rents mark to market, you're able to, of course, capture that inflation and cash flows go higher. The other way to look at it is valuations for real estate go higher as replacement costs go higher. So generally speaking, inflation is positive. I think what's unique this time around, which I personally haven't seen in my career, is that it looks like we're going into an environment where inflation will persist and rise, but we might still have lower interest rates, which the combination of the two could be a really great tailwind for real estate.
What kind of trends have we seen in leasing and rental rates as economies, let's say in Canada and the U.S., emerged from the pandemic? Early in the pandemic, of course, life was pretty difficult for many landlords. They had tenants that were going out of business or tenants who simply could not pay their rent.
That's right. It really is sector by sector. But to touch on that point, on more of the difficult side, it's been office and retail. You think about store closures on the retail side. Almost 3,000 year to date. That's on top of almost 16,000 last year, almost 10,000 the year prior. It's been a very difficult environment, and you're seeing it in the vacancy rates. You're seeing it on the office side on the vacancy rates. We're seeing 18% vacancy rates nationally across the United States. We haven't seen those levels since the great financial crisis. But the antithesis of it is some of the stronger sectors: industrial, single-family rental, apartments. Look at this morning, Invitation Homes. They're one of the largest operators of single-family rental homes across the U.S. Today, they reported 14% new lease growth. So you're really seeing that inflation come through in those sectors where the supply and demand justifies it.
What's the M&A activity looking like in this sector?
It has really picked up, and this is something we had anticipated. Even today, Preqin estimates there's over $350 billion of private capital sitting on the sidelines, and I can count probably 10 transactions that have occurred in the past 6 months. 5 of them public to public in the U.S. REIT side, and 5 of them in the private markets. These are all multi-billion-dollar transactions, which all tell you that for the right real estate, valuations actually have gone higher since the pandemic, and there's a lot of capital trying to chase real estate because of this inflation protection and the nice yields that this sector generates.
What about the price of real estate assets that publicly traded REITs may be interested in buying? What are prices looking like now?
Well, that's what excites us at Vision. Our goal is to buy real estate cheaper in the stock market than one can in the private market. And certainly the private market dwarfs the public market. So we can look at all these transactions in the private market, apply it to the valuation of the publicly traded REITs, and we see a lot of value, particularly in those sectors that we like: apartments, residential, industrial. Even on the grocery anchored shopping center side, we see a lot of inexpensive stocks. And you put it all together in this environment that we've talked about, I think it's the right time to be looking at the sector.
Andrew Moffs is our guest. He's an expert, as you can see, in the real estate sector. He's also Senior VP and Portfolio Manager at Vision Capital. He'll be taking your questions on REITs and real estate stocks through the course of the program. Here's our number one more time, 1-855-326-6266. Please do give us a call with a question to Andrew Moffs. We'll begin with those questions right after this break. Welcome back. Let's start putting questions to Andrew Moffs. Our first question comes from our email inbox. Our email writer is Ruth from Vancouver. She wants to know about Innovalis Real Estate Investment Trust, INO, on the TSX. And she simply asks if you have any thoughts on that real estate investment trust.
Sure. So Innovalis is a small cap REIT focused exclusively on office buildings in Europe. Right now, that translates to France and Germany. It's exclusively listed on the TSX. So inherent there, we always find that stocks that own properties outside of Canada and listed on the TSX trade at a discount. This stock went through a strategic review. I think for the market, it was a little disappointing, the conclusion of it, where they failed to monetize a substantial portion of their portfolio. The market had been hoping that they could close that gap to net asset value. And instead, they're going the opposite way and looking to sell interest in certain assets, purchase, consolidate other interests, and expand into other markets like Spain. Generally speaking, we're not bullish on the office space. This is a tougher sector today in this environment. And today, Innovalis is in a tougher situation because their cost of capital is not where it should be in order to pursue this expansion. So I think you're still going to see some volatility in the stock as holders that had hoped for a sale are disappointed, and you might continue to see some churn in the stock. So it's not a stock I'm looking to buy at this juncture.
Okay, thanks for that question, Ruth. Let's go now again to the email inbox. David is in Maple, Ontario, just north of Toronto. He wants to know about Northwest Health Properties, ticker symbol NWH on the TSX. What are your views on Northwest? It seems to have recovered since the COVID downturn. Is there upside?
So it has recovered, and that's the positive story. Today, the stock trades at a premium to net asset value. Generally speaking, we're a shop that looks to buy real estate stocks at a discount. So that's a positive for Northwest. What does that mean? They can continue to expand globally, which they have, and issue equity in order to do so. Most of their assets today are now outside of Canada, and they've done a good job of buying assets, whether it be in Brazil and Europe. And today, they're really pursuing a strategy in Australia where they've put a hostile bid for a privately listed vehicle in Australia. We think there's a lot of capital that will be needed to close that transaction. Hence, if I were to look at this stock, I'd probably wait for a pullback because, like I said, it trades at a premium. And it's quite likely that later this year, if they prove successful in purchasing that portfolio, they're going to have to raise equity. So I like to wait to buy this stock when they raise equity.
Okay, thanks to David in Maple for that question. Now let's go to the phone lines. Taraver in Phoenix, Arizona is on the line. Taraver, great to hear from you again. What's your question to Andrew Moffs?
Absolutely, Mr. Bagnall. Mr. Moffs, my question is on Public Storage REIT. It's a storage month to month. You can get it. Two parts to the question. First is, can you tell me about the PSA and whether they have a sustainable business? And secondly, there's something called Funds from Operation, FFO. What is that, and why is that important in the REIT evaluation? Thank you.
Sure. So it's two great questions. First of all, Public Storage is the largest operator of self-storage, frankly, globally. They were one of the first in the business. And as of late, they're doing a lot to improve their operations, get a bit more efficient, and try and use technology to do a better job in terms of pushing rents. And that's really been the story with self-storage today. It used to be if you could finally get over 90% occupied, then you could only push rents. Well, today, occupancies are 95%, and they are really having a lot of success pushing through rental rates to their customers. This is a great business. It's very recession resilient. So we like Public Storage. We really like the self-storage space, particularly here in Canada, which is a few years behind. In terms of your question about FFO, FFO is simply the metric for earnings for real estate, whereas the rest of publicly traded companies use EPS, earnings per share. The simplified difference is in real estate, we add back the depreciation expense to the earnings line to really get you more of a cash flow metric. So it is an important metric, of course. You care about the funds from operations of every REIT because these REITs pay out all their income as distributions or dividends. So they need to have that FFO in order to support that dividend. And so in Public Storage's case, it's a very well-covered dividend dividend, and they have tremendous earnings growth on the FFO line.
And funds from operations is the difference between cash coming in and cash going out, correct?
Correct.
Okay. Thanks very much for that. Let's go to our next caller. Our next caller is Nick in Montreal. Nick, thanks for calling. Welcome to the program. What is your question to Andrew Moffs?
Good afternoon, Paul and Andrew. Thank you for taking my call. I just want to know on Storage Vault, if you would purchase it, and if you would, which account would you hold it in? The reason I'm asking, because I was thinking of putting it in a non-registered account, simply because it's on the venture. I'll just hang up and listen to your opinion on. Thank you. Have a good day. Bye.
Well, it's a great segue from the previous caller. Storage Vault is Canada's only publicly traded self-storage operator. And it's a stock we own at Vision. It's actually one of our larger holdings. We think very highly of this company. As I alluded to with the previous caller, the sector here in Canada, the self-storage sector, is probably 10 years behind the United States. And there's much less space available per capita than there is in the U.S. at a time where people are really recognizing the need for it. All it takes is different life events to occur that necessitate self-storage. Storage Vault, I wouldn't, when choosing where to hold it, it's not so much the question of is it a venture listed stock or TSX listed stock. At some point, this will be listed on the TSX. So I wouldn't think of it that way. What is unique to Storage Vault, which is different than a public storage, for example, or some of the other companies we're going to talk about, is that it is not a REIT. It is a company. And so it gives a lot more versatility in the sense of it doesn't have to pay out all its cash flow. It retains a lot of cash flow every year, which is very positive when you're in growth mode, which they are. So they have been on an acquisition spree as they are getting a lot of synergies out of buying more and more self-storage facilities. So I think it's a name you can own in either portfolio, but it's going to be more of a capital gains. So that's how you can decide if you want to own it in a registered account or in a taxable account.
Okay, thanks to that first batch of questioners. We'll take a break and get back to more questions to Andrew Moffs right after this. Here's our number again, 1-855-326-6266. The email address is marketcall@bnnbloomberg.ca. Welcome back. Andrew Moffs of Vision Capital is our guest. He's taking your questions on real estate stocks and real estate investment trusts. And Ameem in Calgary is our next caller. Ameem, thanks a lot for calling. What's your question to Andrew?
Thank you. My question is on Dream Industrial REIT, symbol DIR. It is trading around $16 right now. Do you still see more upside to the price? I want to buy for my non-registered account for income, and is a dividend safe? Thank you.
Sure. So Dream Industrial is a REIT focused on industrial globally. They own a portfolio in Canada. They own portfolios across Europe as well as in the United States. We're very bullish on Dream Industrial. It's been a stock talked about in the past. We continue to own that stock. And even at these levels, it has done well. We continue to think there's upside. It's simply based on the valuation. It's easy to see net asset value north of $17. And that's based on cap rates that we are seeing in the private market. A cap rate is the inverse of a multiple. It's the going-in yield when one purchases real estate. And it's very similar to a bond. The lower the cap rate, the higher the value. And so when we look globally, we see cap rates much lower than the implied cap rate of Dream Industrial REIT. So its distribution yield is very safe. This is a sector, the industrial warehouse sector, has many tailwinds behind it. E-commerce, of course, is the number one reason. And as the supply chain reconfigures to get goods to all of us quicker than in the past, it's going to be a positive tailwind for Dream Industrial, particularly in Europe, which has seen e-commerce penetration lower than North America. So we think there's a lot of upside to the assets there, particularly on the rental side. As that demand flows through from the supply chain down right to the demand for new warehouses, we're going to see rents increase dramatically, just like we've seen here in Toronto.
Okay, thanks for that question. Let's go to Andre now. Andre is in Chilliwack, BC. Andre, thanks a great deal for calling. What's your question to Andrew Moffs?
Paul. Great show today. Let me tell you, I would agree with the guest. This is a wonderful sector. This group is just on fire. I own Tricon Residential. Just keeps going up and up, and I keep making more money. Would you buy more? Thank you. Have a good day there.
Well, we're just as positive on Tricon Residential. That's a stock focused on the single-family rental housing sector in the U.S., really focusing on the mid-market affordable sector, and they focus on the U.S. Sunbelt, where a lot of the jobs are being created and the population is moving to. This stock has done extremely well, and we see no reason why it can't continue, and that's predicated, again, on valuation. You look at the valuation of this stock, its implied cap rate is more in the almost high 4% cap rate range, almost a 5%, whereas its peers are either in between 4 and 4.5%. If I apply those cap rates to Tricon, there's almost 20% upside. Now that's talking on the yield side, not to mention what's great about this sector is it's really just a collection of single-family homes. And all one has to do is look at home price appreciation, which has been double-digit across the United States, and then look out into the horizon. And I take John Burns, who's a well-established independent research provider in the United States, and his research shows that home price appreciation should be north of 6% next year. So all this bodes very well for Tricon. We continue to own it, and we continue to buy it at these levels.
Interesting. Mike is in Ottawa, and he's up next. Hi, Mike.
Choice Property REIT, just as in the TFSA, just as a nice stable side of the portfolio. And I'd just like to hear comments on it, and maybe if there's a street consensus on this.
So Choice Properties REIT is certainly that stable income provider that you can add to any portfolio. We like Choice Properties. Its largest tenant is Loblaws. It has some great real estate nationally. And because of its net leases to Loblaws, essentially, this is really a secure cash flow. And what analysts typically do is comp this to the bond yields that one can get from buying Loblaws. And we haven't seen in quite some time as wide a spread between Choice and Loblaw bonds. So I think that it's attractive on that level. What's unique about Choice, whereas there's some other companies and REITs one can buy that provide stable cash flow, is that it also has an element of growth, and that's what's attractive to us. They have, like I said, a great portfolio across Canada. Some of these assets have been owned 100 years, and there's great redevelopment potential. Not to mention that Choice also has about 15% of its portfolio stemming from the industrial warehouse sector, which is providing a lot of growth. So it's that nice combination of safety and growth that you don't often find in a lot of REITs, particularly with its focus on the retail sector. So it's a stock I would continue to own and feel good about, sleep well at night owning that distribution yield.
And the analyst consensus, or the analyst distribution of ratings, Mike, is 1 buy, 7 holds, and 0 sells. So of 8 analysts who cover the stock, that is Choice Properties REIT, 7 are hold, 1 is buy, 0 are sells. Let's go now to Dennis in Montreal. Dennis, thanks a great deal for calling. You're up next with Andrew Moffs.
Yes, hi, guys. Great show as usual. Thanks for taking my call. I have a RIF, and I have some U.S. dollars in my RIF, and I'm looking for dividend. If you have any suggestions about real estate ETFs, REIT stocks in U.S. dollars that pay a good dividend, I will hang up and listen. Thank you. Have a great day.
Sure. I mean, there's lots of suggestions for you. If you're specifically looking at an ETF, VNQ, the Vanguard REIT Index, is always a good option. I believe the dividend yield is probably below 3% today, probably high twos, and that's always a good way to get broad diversification across REITs, as it covers all the different sectors. We of course at Vision like to focus on those sectors that have the tailwinds and then go bottom up and try and find the discounts. And likely you're going to be better off at a minimum purchasing those stocks that are in those types of sectors that have good demand and supply characteristics. So where am I leading to? If you wanted to put those US dollars to work on the TSX, you could buy two stocks. You could buy a stock WIR -U, that's a WPT REIT. They focus on industrial real estate, or you could buy BSR REIT, ticker HOM, which focuses on apartments, both US dollar denominated, both listed on the TSX, both in sectors that we like.
Okay, thanks, Andrew, for that batch of questions. Thanks in particular to everybody who put a question to Andrew. We're not finished yet with your questions, but we'll pause because after this, we're going to deal with Andrew Moffs' past picks next. Time now for past picks on Market Call. Andrew Moffs is our guest. He's Senior VP and Portfolio Manager at Vision Capital. Real estate is his expertise. And we'll talk now about some picks that he gave us about a year ago, July 25th of 2020. One of them we've talked about already, Tricon Residential, TCN on the TSX. I know we've talked about this one before, but let's hear your views again, Andrew, and you can elaborate anything you missed the first time around when you responded to a question. This one was recommended when it was trading at $8.85. That's Canadian. This trades on the TSX. It is now trading at $14.88. That's a return of 68%. Factor in the dividends, and you get 73% as a total return. What are your thoughts on Tricon, Andrew?
Yeah, so like I mentioned previously, it's one we continue to be bullish on. If I think back to a year ago when we made this call, what's so interesting to me is in the midst of the pandemic where people were worried about collection of rents, Tricon acted as a good citizen and decided not to pass on rent increases to its residents, despite the fact they probably could have. Fast forward to today, and you're seeing meaningful rent increases because now there's a large mark to market. And it's one of the few real estate asset classes where we saw positive cash flow last year and continuing into this year. So we continue to be bullish on it. The valuation really supports the stock. The other catalyst to the stock last year was there were questions about its balance sheet and its high leverage. Well, that got solved. Blackstone led an exchangeable preferred offering last August. We had Vision participated in it, and it turned out to be a great catalyst for that stock and really helped solve the balance sheet. And today they sit with a great runway where they have a lot of capital to put to work and be one of the consolidators in the single-family rental sector at a time where they arguably still trade at a discount to net asset value.
And so you are undaunted or unconcerned about the fact that the shares are up 60% over the past year and trading at a clear 52-week high, and quite likely that may be an all-time high for the stock.
It definitely is, and it's just like Wayne Gretzky, you have to skate to where the puck is going, and the demand and supply tells you that this sector has a lot of growth ahead of it.
Okay, let's go to the past pick number 2, European Residential REIT, ticker symbol ERE on the TSX. Recommended when it was trading at $4.21 Canadian per share, now trading at $4.42. That's an advance of 5% as a return, 9.5% as a total return.
So this company, we continue to own it, we continue to think highly of their strategy. They're exclusively focused on apartments in Europe, but listed on the TSX. It's one of these rare situations where we find a stock that's only had positive same property net operating income growth. It's only had positive total portfolio NOI growth throughout the pandemic, yet it still trades below its stock price prior to the pandemic. Of course, we've had the yield to generate the upside. We think this is one of the cheapest residential stocks globally. If you looked at some of the peers that are listed in Europe, you would find them trading at premiums to net asset value, and this one is trading at a discount. We think the upside is north of $5 from here. It trades at an implied cap rate about 3.6%, and one can easily argue and see the transactions occurring in the private market occurring in the low 3% range. It's a company that's sponsored by Canadian Apartment REIT, We think highly of management, and they're operating in the Netherlands where there is a housing shortage. So again, this is a sector with a lot of tailwinds to it, and we see cash flow growth as well as net asset value growth in this stock.
Okay, final pass pick, Granite REIT, ticker symbol GRT on the TSX, GRT-U, trading at the time of recommendation about a year ago at $67.83, trading now at $86.15, a return of 27%, a total return of 32.5%. Andrew?
So Granite's a stock we continue to own. It's done well, and today I'd say it has a lot more stability to it. It still trades slightly below net asset value, probably about 5 or 6% below net asset value. You still generate a 3.5% distribution yield, so you get close to about a 10% return, which is pretty attractive for a stock operating in the industrial warehouse space. They do this globally, similar to Dream Industrial. They focus on Europe, the United States, and Canada. And if you look at the peers in the United States, they're all trading at implied cap rates of a low 3.5%. And this one's trading more in that 4.5 to 4 3/4 cap rate range. So we think it's well supported on the valuation side, very safe distribution. And so it's a stock we continue to own.
Those are the past picks and Andrew's thoughts on those past picks a year later. All of them in positive territory, 2 of them substantially, 1 of them by a slender margin. Here they are again. Tricon Residential was the first one. He took a question on that stock earlier in the program. Total return of over 73%. European Residential REIT, total return of 9%. And Granite REIT up 32% on a total return basis. That's an aggregate total return for those 3 picks from a year ago of 38.5%. Stay with us. More questions to Andrew Moffs after this. Welcome back to Market Call. I'm Paul Bagnall, sitting in this week for Andrew Bell. Andrew Moffs of Vision Capital is our guest. He's an expert in real estate stocks. And Gordon in Calgary is our next caller. Gordon, thanks for calling. What's your question to Andrew?
Thanks very much for taking my call. My company I'm asking about is Invescu on Toronto. The yearly chart looks terrible. I own the debentures, so I feel a little bit safe, but I'm wondering what your opinion of the company is. Do you think it will make it? Thanks very much.
So Invesc is one of those high-risk, high-return companies. We think highly of management. They've done a very good job of growing their portfolio despite having a difficult cost of capital. They focus exclusively in the United States, but listed here in Canada, and they operate in the healthcare sector. And that's been a difficult sector, specifically on the seniors housing side, on the skilled nursing facility side throughout the pandemic. As a result, the stock has suffered. And it's not obvious what the catalyst will be, notwithstanding the fact that a lot of its peers in the U.S. Are now trading above pre-pandemic levels. The stock is not. So it really comes down to what they can do to close the gap. I think by virtue of owning the debentures, you likely have a bit more security in terms of the cash flow. And thus, depending on your risk tolerance, you might choose to continue to hold. But if you're more risk adverse, this is probably not a stock to own, because it can be quite binary in terms of the outcome, whether or not the cash flows will continue to support the current distribution levels.
Let's go. Thanks for that question, Gordon. Let's go to Terry in Toronto. Hi, Terry.
Thank you for taking my phone call. I'm interested in your perceptions of O, the symbol ticker in the States, the Realty Income Company or something like that. On their propaganda, they seem to say something about over 500 months and never missed a dividend. Anyhow, I'd like your perception. I'll hang up and listen, and thanks again, and you guys stay safe.
Thank you very much. So Realty Income is one of the largest REITs in the United States. Ticker correctly is letter O. It pays a monthly dividend. I think it's around 4%. So that's the attraction. It owns primarily retail assets now globally. These are net lease assets, so it means long-term leases to single tenants, whether it's a drive-through, a pharmacy, a grocery store, et cetera. And this stock trades at a very large premium to net asset value and a high earnings multiple. So that's a positive, meaning they can continue to raise capital and continue to buy assets and make it accretive to the overall enterprise. As a result, they're actually buying a publicly traded peer, VERI, ticker VER, and they'll just continue to grow. It's more because it is so large and owns many properties. It's well diversified. So hence, that term you use, propaganda. In their propaganda, they are able to tout an uninterrupted dividend because it is well supported by all these properties, and no one tenant can really hurt the enterprise. And I think it's large enough at this point where you can feel secure in terms of that monthly dividend. It's not typically a stock that we would own, just given the high valuation of the REIT today.
Let's go to Ryan. Ryan is in London, Ontario. Ryan, thanks for calling in. What's your question to Andrew Moffs?
Hi, guys. Thanks for taking my call. Good show. Andrew, I'm interested in your thoughts on Kimco Realty. Trades in New York, and their impending as well, their impending merger with Weingarten Realty, symbol WRI. I gather that's in New York as well.
Correct. So Kimco is one of the oldest, largest shopping center REITs in the United States. Weingarten actually is as well. And it's a merger that makes a lot of sense. Weingarten has been more focused on the U.S. Sunbelt, where we see a lot of growth. And they've actually been active in terms of doing some mixed-use development on some of those shopping centers. So we think Kimco will do well with this transaction. They have a young, energized management team that's doing very good transactions where development has been a core competency for them in terms of more redevelopment in their portfolio. We like the grocery anchored shopping center sector, generally speaking. Kimco has rallied at this point through its net asset value, in our opinion. And hence, while we like Kimco, we like the management, as I said, I like the sector, we think there's more value in some other stocks, particularly north of the border here in Canada, whether it's in RioCan or First Capital Realty. So Kimco, if you own it, I continue to hold it. It's a safe dividend, but I think there's probably more value in other names.
Okay, let's take a break, and when we come back, we'll continue putting questions to Andrew Moffs. Thanks for all your questions. More coming up after this. Welcome back to Market Call. I'm Paul Bagnall. Andrew Moffs is our guest. He's with Vision Capital. Real estate stocks and REITs are the subject of today's program, and Mike in Montreal is next. Mike, thanks a great deal for calling in. What is your question to Andrew Moffs?
My question is, I'd like to know his thinking about Canadian Apartment REIT.
So Canadian Apartment REIT, CAP REIT, as we call it, is one of our favored multifamily stocks that we own in our portfolio. It's focused across Canada, owns a portfolio with a concentration here in Ontario, and it trades at a discount to net asset value. We think management is very strong, and we, generally speaking, love to buy these companies that are in the right sector, like apartments, and trade at a discount to net asset value, where we see a catalyst. And really, truly speaking, the catalyst for the Canadian apartment space, generally speaking, is the return of immigration and the commitment the federal government has made to record immigration levels annually over the next 3 years. The type of housing that CAP REIT delivers is affordable to these new immigrants, as well as all the foreign students that come to Canada looking for housing. Canadian Apartment REIT offers a great apartment unit for them. So I think overall it's a stock that has a great combination of value and growth, and hence we continue to own it in our fund.
You seem very bullish on real estate entities that are exposed to residential real estate. We've talked about Tricon a couple of times in this program. It's active in the United States. CapREIT is active in Canada. And I can tell viewers there's one more in this space coming when we talk about top picks from Andrew Moffs at the end of this program. You've mentioned immigration. What other factors lead you to be so keen on the residential space right now?
Well, it's like any business is about demand and supply. So I've talked about the demand factors. One other element of the demand factors one has to think about is you've had a lot throughout the pandemic, so many people in that age cohort between the age of 20 and 30 likely moved back home or doubled up. And as they moved away from urban centers and didn't, could either work remotely or go to school remotely. And I think what you're going to find this leasing season come the fall, you might have a double cohort of people looking for housing. So I think on the demand side, it's very attractive. And then certainly on the supply side, I mean, any new apartment dwelling that is being built today across Canada is at a much higher rent level per square foot, because that has to justify the high cost of development, whether it be on the demand side or, on the land side, or on construction cost side. And hence that level of apartment rent, whether it's called $2,000 per month, is much higher than the average rent that a CapREIT or an InterRent, for example, provides in that $1,200, $1,400 range. So it doesn't compete. So you have no new supply effectively at a time where demand is increasing.
Peter in Vancouver, thanks for standing by. What's your question to Andrew Moffs?
Thank you for taking my call. Great show. And Mr. Moffs, one of the greatest and my favorite on the REIT sector. Can I have your expert opinion on CT REIT? CT REIT. Thank you.
My pleasure, and thank you for that. CT REIT, the Canadian Tire REIT, very safe portfolio, leased long-term, primarily to the Canadian Tire. Again, here one has to focus exclusively on the cash flows. How secure are those lease payments from their largest tenant, and what is the credit quality of their tenant? And again, both rank pretty high. So we feel pretty good about the distribution quality of CT REIT. That's really what you're buying it for. It doesn't have a ton of internal growth. The rent that when rents come up for renewal, they're preset in terms of what the increases can be, and they're generally set lower than what you're typically seeing in the market, which is okay. So I find CT REIT is just a very safe way to participate in real estate, but you're not going to generate a ton of upside because the growth is more muted internally. What they can do is on the acquisition side or the development side, which until now hasn't been extensive, but that is going to change as they start to have some very productive developments come online. Think at Yonge and Eglinton in Toronto, they have a great site there, which will be a multi-phase project over the next decade, which will add an element of growth to the portfolio.
Okay, thanks to everybody who put their questions to Andrew Moffs. Thanks to Andrew for his great answers through the course of the program. That's it for the questions, but not it for the program. Top picks are coming up right after this. Welcome back. It's time for Top Picks from Andrew Moffs. He's with Vision Capital. He's taken your questions through the course of our program on real estate stocks. I said earlier there was one more coming in the residential real estate space. I was mistaken. There's actually two of these three top picks that are in that space. Number one is BSR REIT. It trades under the ticker symbol HOM.U on the, or -U on the TSX. It is involved in residential real estate south of the border. Andrew?
Correct. So HOM, it actually trades in both U.S. dollars and Canadian dollars. I think of it in U.S. dollars, trading around $13.40. When I look at this REIT, first of all, it's focused on U.S. apartments, particularly in the U.S. Sunbelt, in the high-growth markets of Dallas, Houston, and Austin, as well as Oklahoma City. It is the best way to get exposure to those markets globally. This stock is trading at a discount to its net asset value, whereas all its U.S. peers trade at a premium. If I look at the valuation, it trades at a 5% implied cap rate. that is very high. One couldn't go out today and buy an apartment building at a 5% cap rate. You'd have to pay something more like a 4% cap rate. If I even put a 4.25% cap rate to the earnings of this REIT, I come up with a value north of $17, almost $18. So that's over 30% upside. And I'm not saying it's going straight there, but what we like about this REIT is that you are supported by the valuation at a time where the fundamentals are very strong. So we have a great backdrop of increasing demand, and the REIT has done a great job of capital recycling, and they are putting more capital to work in their market. So we're very bullish on the prospects for BSR REIT.
Can you very briefly explain the cap rate measure, which is so important to valuing real estate entities?
Yeah, so it's the denominator in the equation. So you're basically taking the earnings and you're dividing it by cap rate, which is what I meant before. It's the inverse of a multiple, very similar to a bond yield. So it's when I purchase an asset, the 5% means what's the first year return for that asset, 5%. And hence, the lower that cap rate, the higher the value.
Okay, let's move on to top pick number 2, WPT Industrial REIT, ticker symbol WIR-U or .U on the TSX. What are your thoughts on this one?
Very similar to BSR. It trades in both U.S. dollars and Canadian dollars. On the U.S. dollar line, it's trading just under $19 today. And again, here, the implied cap rate, just under 5%. And this company exclusively focused on industrial warehouse across the United States. When I look at transactions that are occurring in the private market, look, recently Blackstone just bought a portfolio called Cabot, paid a 3.5% cap rate. And all the other REITs in the U.S. are all trading in and around 3.5% cap rate. So the market in the U.S. has gone the valuation correct. Here in Canada, we still trade at a discount. That implies about 20% upside in WPT should it get the same valuation as both the private market and its peers in the U.S. We love the industrial warehouse space. The tailwinds are immense given e-commerce and the need for modern distribution warehousing, and that's exactly what WPT provides.
Okay, finally, here we go back again to the residential space. Boardwalk REIT, a familiar name to REIT investors for many, many years in this country. Ticker symbol BEI-U in Toronto.
So Boardwalk focuses more in Western Canada. About over half of the portfolio is in Alberta between Calgary and Edmonton. It's been a tougher geography to be invested in. And for us, Boardwalk is a relatively new way to express optimism in that market. We spend a lot of time with brokers in various real estate markets, and what we have found talking to brokers out west is that concessions are going away, and we actually might see them disappear in Calgary come the fall. Boardwalk's been operating with 1-month concessions typically, and we might even see them go away by the end of the year in Edmonton. If that happens, you're going to see substantial cash flow growth at a time where the REIT is trading at a very wide discount to its net asset value. Put it all together, we think there could be 30% upside. It does come with risk because, of course, this market has been more susceptible to the vagaries of oil. But for now, the unemployment rate in Alberta has actually gone lower than most parts of the country. And so we think that's bodes pretty well for a stock as in a market that's kind of churned through a lot of new supply. And today, the upside downside is in favor of owning this REIT.
Andrew Moffs, we want to thank you a great deal, and I'm sure our viewers do as well, for all your contributions today to our program. Andrew Moffs, Senior VP and Portfolio Manager at Vision Capital. That's it for us on today's program. Time to turn things over now to Amanda Lang and Bloomberg Markets.